of this 6 video series, and today we will be talking about accounting cycle. So what basically is accounting cycle? It is an accounting terminology which involves the systematic recording, summarizing and reporting of financial transactions. So it includes several multiple step method. So it includes several steps. So the first is analyzing transactions. So recording all the financial transactions in a chronological order in a general journal. Then there is a second step which involves the posting to ledgers. So it transfers all the entries that were recorded in a journal and move them to specific accounts. So each account has its own specific ledger account in which only amounts of that account are transferred. Then there is preparing the trial balance. In trial balance, we summarize the account balances to confirm that debits, how much there are debits and how much there are credits. So there are basically two sides, two columns. One is debit, one is credit, and all of the transactions are listed there. So then there is a fourth element, which is adjusting the entries. So by adjusting entries, we mean ensuring revenues and expenses are recognized in the correct period, which is basically related to recognition principle, that revenues and expenses must be recognized when they occur, and then we move towards the financial entries, financial statements. From these we prepare, the businesses prepare balance sheets, income statements, cash flow statements, and other financial statements. Then after making financial statements, we perform the closing entries. So it means finalizing the temporary accounts for a particular period of time. So this cycle ensures the accuracy, accountability, and transparency in financial reporting. So now moving on to next slide, which is about recording transactions in journals or general journals. So it is the first step in the accounting cycle, and it involves the recording of transactions in a journal, also known as the books of original entry. Journals organize financial data in a chronological order in which the transactions have taken place. So the components of what are the components of a journal entry? So first we mention the date on which that transaction is recorded for clarity purposes. Then we list the accounts that were involved. So in this step, we specify the accounts that are affected by the transaction, including the debits and the credits. Then the third component is amount. So it is the monetary value or the money of the transaction that is listed under the debit and the credit column. Then finally there is a description, or you can call it explanation if you want to. So it is a brief description of the transactions which ensures clarity and traceability. So there are certain types of journal. So first is general journal. So it is used to record transactions that are basic and everyday transactions. And then there is special journals in which only the repetitive transactions that occur multiple times they are recorded. So these were the two types of journals. So the recording these transactions in journals are the financial activities that are that mean recording in a systematic way. And then we move on to next slide. That is the debit and credit rules. So that in the double entry accounting system that we will further discuss. So it relies on debits and credits to maintain a balance in a accounting equation, which I told you in the previous video is the assets is equal to liabilities plus owner's equity. So each transaction affects at least two accounts. One is from asset side and the other uh, one goes to asset side and another goes to liability side. And in general there are two entries. One account with debit and other with credit. So what are basically rules of debit and credit? So first let's discuss the rules of debit. If an asset or expense increases, so there will be an increase in debit, and if the liabilities and the equities decrease, so there will be a decrease in it will be debited. And then there are credit rules. So which entry will be credited? So the first will be there will be an increase in equity or revenue or liabilities. It will be in credit, and if there is a decrease in asset, it will go in the credit. So for example, so when a company receives cash from a customer, the cash account and asset is debited, and subsequently the revenue amount is credited, or so this was an example of the debit and credit. So this system also ensures the accuracy, as debits and credits are equal for every transaction. So they remain in a perfect harmony, or a balance, if you want to call it that. So then we move on to double entry accounting. So double entry accounting is the cornerstone of the modern financial management or modern accounting. It ensures that every financial transaction impacts two accounts, one as debit and one as other as credit. So what are the key elements? So the first element is asset. So when the resources owned by a business, such as cash, so these are owned by business such as cash, equipment, and building, land, etc. So they come under asset, as we discussed in the balance sheet. Then there are liabilities, that are obligations of a firm that it owes to other parties. Then there is equity. So it is the owner's investment, owner's capital in that he has invested in the business. So for example, purchasing a machinery for cash decreases the cash account, which will go credit, and it will increase the equipment account that will go into debit. So this dual impact maintains the balance in the accounting equation, which ultimately affects the balance sheet, and balance sheet also remains balanced as well as journal entries. So double entry accounting reduces errors. It provides detailed financial records and ensures reliability. So moving on, we move towards the next slide, which is about posting on the ledger. So after transactions are recorded in journals, they are posted to the ledger. The next step is the ledger. So the ledger categorizes the transaction into specific accounts, so such as cash accounts and receivable accounts. Each of these accounts, say cash account or receivable account, they have their own ledger, and all of their entries are recorded in there. So what is the purpose of this ledger? So it provides a summarization. It condenses the journal entries by account, making it easier to track the balance. So then they are also essential for the preparation of the trial balance. So they are used to create the trial balance, which is the next step. So each ledger account has a T account. T account, which with a debit on the left side and the credits on the right side. So this positioning ensures that the detailed transactions are recorded. And then we move on to next slide, which is about preparing the trial balance. So the trial balance lists all the ledger accounts and their balances at a specific date. It serves as a preliminary check to ensure that the debits and the credits are equally, if you must say, and then these entries are transferred to balance sheet. So in this we list all the accounts and their respective balances. So these balances are separated into debits and credit columns. So the total of each column is will confirm that they will be equal. So while the trial balance can detect errors like transposition or omission, it cannot catch the mistakes such as recording the wrong amount that might have happened in a journal or in a ledger. So moving on to next slide, which is about income statement and retained earnings. So income statement, it basically, as we have discussed earlier, it reports the revenues, the expenses of a business, and whether that business has gained whether a particular business is in profit or in loss in a particular period of time. Then there comes the retained earnings. The retained earnings we get after providing the dividends to all of the shareholders, and that will be added to the equity part of the balance sheet. In the next slide, we move on to the time period principle. So the companies usually choose a particular time period. It may be annual, it may be semi-annual, it may be monthly, or it may even be quarterly. So they decide it once and they stick with it throughout their business model. And then these remain consistent for businesses because for a longer period of times, months, whatever they have chosen. So it provides comparison. It can help us compare our performance to other businesses during that particular time period. So now let's move on to the final slide, which are the concluding remarks. So understanding the accounting cycle is very important because it is basically the core, the crux of any organization, and it provides us a view on the financial health or performance of a particular business. So that was it from this chapter. I will see you next week.